Yeah, I think we can slowly start. We still have a few minutes. Great. Okay, good afternoon, everyone, and welcome to today's webinar, which is a webinar jointly organized by CMCC and the NEWPATHWAYS project. My name is Johannes Emmerling, Senior Researcher at CMCC. And just 2 minutes to introduce it. So the project actually is a project that just started this year called NEWPATHWAYS, coordinated by the Potsdam Institute for Climate Impact Research, with a large set of partners that you can see here, including the partner institutes of the speakers of today's webinar, and including also other partners outside of Europe. So with really the goal to produce, let's say, new pathways of the climate mitigation transition at European and especially also global scale from many aspects. I don't want to bore you too much with the details of the projects, but there's a lot going on in developing pathways at the global level for specific countries. A lot of data is being produced and collected, and let's say I'm focusing here also on the financial side in terms of financial flows, transfers, policies, and also cost of capital. And some of that we're going to talk about in today's webinar. This is actually just let's say the kickoff of the webinar series that we were launching within this project, and we have already a next one lined up for December that you can see here, where Mark, colleague from PBL, will be talking about the fairness aspect, right? There's a lot on policies of fairness, which emission targets between countries are considered fair, or kind of unboxing the question what fair means, talking about national policy and emission targets. Just a few, let's say, housekeeping rules. We have by default, this is the webinar version of Zoom, so audio and video by ID deactivate, but you can raise your hand or write a question to the speakers in the Q&A box. And in case you can also raise your hand, in which case I can also give you the floor to ask your question verbally after the presentation and the discussion. Just a reminder that this webinar is also being recorded and will be made available on our YouTube channel with a set of other webinars that you can find under this link. Okay, but now moving to today's topic. Today we're very happy to have Paul Weiderlich here from the ETH in Zurich, and Simon Fankhauser from Oxford University, that will be talking about I think very important topic on the role of let's say the energy transition and how finance interacts. So here in particular, how, let's say, export finance matters and how the transition from fossil fuels and fossil fuel energy financing to renewables is occurring, or what needs are there, etc., and what role this plays. Paul is now a postdoc at ETH Zurich, and he completed his PhD successfully last year, and is now focusing a lot on the topics on low carbon finance technologies, and yeah, has produced a lot of work in this research. And we're also happy to have Sam with us here, who is a professor for climate economics and policy at the Smith School at Oxford. And yeah, he has held various roles, including LSE, I think, where Paul and Sam also shared an institute. Many roles, very active in the UK, but also global and European environmental and climate policy research and policies. So very happy to have you here. And without further ado, I will give the floor to Paul, and you have about half an hour for the presentation, 35 minutes. Then we have 10 minutes for thoughts and discussions from Sam, and then we open up the floor for Q&A from the public. And with that, Paul, over to you, and let me unshare my screen.
Yeah, thank you very much, Johannes. Let me just quickly draw up my slides. All right. You should be seeing them now. Yeah.
Yes.
I see people nodding, which is great. Yeah. Also, a warm welcome from my side, and thank you to the NEWPATHWAYS project, and also to CMCC as the organizers for the opportunity to present this joint work led by Philip Jęczkowski from the University of Lausanne about the shift of public export finance from fossil fuels to renewable energy, which was published earlier this year in Nature Communications. And over the next 30 minutes, I will try to first introduce the concept of export credit agencies to those of you in the audience that might not be familiar with these kind of institutions, and try to convince you why these institutions are quite important and influential for climate change mitigation in particular. And then I will briefly walk you through the data and methodology of the paper, some key results, and then conclude with some policy insights and maybe also avenues for future research. So why, maybe let's take first a step back before we dive into the export credit agency part of this work, and just think about reasons why finance at all matters for climate change mitigations. And I think there's at least two key reasons that need to be considered in this context. First, and I'm sure you have seen this chart or a similar chart a few times by now, the investment needs of the low carbon transition are quite substantial. So this comes from the IEA's World Energy Outlook. And as you can see, over the next decades in OECD countries, we need clean energy investment to basically double. But then when we look at developing countries other than China, we need an increase of 6x or even larger. And that money, of course, needs to come from somewhere. And this is one of the key reasons. A second reason, which maybe is a bit less discussed sometimes, is the impact of financing cost on the competitiveness of clean energy technologies. And the main reason for this is that if you compare, for example, onshore wind or solar PV as clean energy tech to the fossil fuel alternatives, so firing coal or natural gas to produce electricity, then the renewable energy technologies have most of their costs occurring upfront. So before you even started producing electricity, and they're very low, what we call operating expenditures, so costs that only occur once you start producing. And that means that you can't really finance these costs from the revenues that you're already generating, which means you need upfront financing. So in other words, these technologies are very capital intensive. And that usually means that the financing terms are worse, and this is what's shown here in the chart on the right from comment by Toby Schmidt. If the financing terms get worse, then the unit cost of electricity increase much more for renewable energy technologies than for fossil fuels. And that means that we have this direct link between financing conditions and the cost competitiveness of these technologies. And for these reasons, but of course also for others, the role of finance was actually enshrined in the Paris Agreement in a very prominent part, Article 2.1. Where one of the key goals right next to the temperature target of keeping global temperature increase well below 2 degrees is to make finance flows consistent with the pathway towards low greenhouse gas emissions and climate resilient development. And that's a very, very important target, but at the same time, there's some key challenges involved here. And one of them is that the risk return profiles, and sometimes maybe even just the perceived risk return profiles of climate change mitigation investments do not always meet investors' expectations, and especially in low and middle income countries. So the chart on the right basically tries to illustrate the concept that as the risks of an investment opportunity increase, typically you'll see investors and also lenders demanding higher returns, meaning that if your project falls below the blue line here, market line, it's usually deemed unattractive by the private sector. And then basically that will mean that you will struggle to secure the financing you need for that project. And in developing countries, that can be especially the case for multiple reasons. For example, being currency stability issues, which then leads to FX risk. You can have issues with debt sustainability in the public sector, which matters a lot because particularly the energy sector is often state-owned. And to address this challenge, governments can basically use financial policies to induce investments in two different ways. First, if your project falls below this blue market line on the right, as a public sector, you can just provide loans or other forms of investment directly and just finance them anyways because of some societal benefits related to these projects. Or, and that is a bit closer to the topic of today's webinar, you can try to basically get them above this blue line by either increasing the return or by reducing the risk. And this is usually referred to as so-called de-risking clean energy financing. And even when it comes to those two instruments, direct loan provision and de-risking, we actually have a pretty good understanding by now of a lot of public financial institutions that engage in these two activities. For example, state investment banks, multilateral development banks like the World Bank, also bilateral aid institutions. But there's surprisingly little research on export credit agencies. And if I had to define those in one sentence, it would basically be a public financial institution that's mandated to support the export industry. Maybe this definition is not enough for you to have a clear understanding. So maybe let's follow it up with some key examples for different regions. So if you're from North America or working in that context, maybe you've heard of US Exim or the Canadian EDC. In Europe, we have the Italian export credit agency, SACE, the French BP France, then in Germany, an institution called Euler Hermes, which is now called Allianz Trade, and which is an interesting institution because it's actually not public itself. It's just, it has a basically publicly ordered or mandated segment of its business. Then when we move to East Asia, we have the Chinese institution, Sinusure, and the Export-Import Bank of China, and then also similar dual institutions in South Korea and Japan. And at this point, maybe you might be wondering, why do we have two institutions for the same country? And the key reason is that for supporting export industries, ECAs basically use two different, what you would want to call maybe financial instruments or also financial commitments. And one of them is basically coming back to this de-risking role. So you use state-backed guarantees or insurance products to reduce the risk of projects. So for example, imagine that you're building a wind park somewhere and you have a domestic exporter manufacturing the turbines, sending them to this wind park. Then one of the things that ECAs might do is to basically just provide contract insurance in case of non-payment. So that even if there's some hiccup with the wind park being developed or being built, the turbine manufacturer will still get paid for the turbines delivered. So this is a very short-term product that ECAs issue. And then on the longer term side, which is more what we are interested in the paper I'm presenting, you can typically see insurance being issued for investors if they invest in countries that are politically risky, for example, due to expropriation risks, or if they invest in technologies that are risky, at least at this stage, because they're very novel, they're not proven yet, there's not a lot of track record of them working. And then basically what the ECAs will do is they will issue some kind of guarantee or insurance that assure whoever provided financing from the private sector to this project that if the project goes default or if there's some kind of delays in construction operation, you will still have your losses covered. And that then usually increases the willingness of private investors and private banks to issue financing nonetheless. Typically, what ECAs do is that they provide these kind of products, also the direct loans that they issue on commercial terms. So they're not concessional like development finance institutions, although they sometimes offer some kind of concessionality in low income and lower middle income countries. And what's important is that these activities by ECAs are not exclusively occurring in the public sector. So you also have so-called private ECAs. There's a few key differences here. So public ECAs, or sometimes also called official ECAs, are explicitly mandated to support the domestic export industries. They're typically more active in longer-term loans and guarantees, and they usually have a higher risk tolerance. So the idea is that they would go as a guarantor or as a lender where the private sector does not dare to go. The key piece of regulation in terms of ECA activity is the so-called OECD arrangement, which is kind of a gentleman's agreement between most, but not all, OECD member states, basically regulating what terms these public ECAs can offer to ensure that there's some kind of a level playing field. And why are ECAs so important? I think there's basically a pretty clear reason, because they just enable all these projects that just would not be feasible without them. And I think the best way to see this is if you zoom into energy mega projects, which are very risky by design. And then typically you will always find a public ECA somewhere involved in the transaction. So just two key examples here. One from the fossil fuel side of things, the so-called Mozambique LNG project, where the French oil and gas company Total wants to exploit substantial offshore gas reserves off the coast of Mozambique. There was a $20 billion final investment decision in 2019, and the financing of this project included included some multi-billion loans by the US and the Japanese Export Credit Agency. And then on top of that, there was also loans by private sector institutions that were then guaranteed by many other ECAs, including the Italian institution. And the project is currently, which I think illustrates quite nicely the need for some of these guarantees and insurances, on hold due to regional conflict, which led to a force majeure declaration in 2021. But on the clean energy side, we basically see some very similar patterns. So this is the NEOM green hydrogen project in Saudi Arabia, which is huge in scale, 4 gigawatts of renewable energy capacity, 2.2 gigawatts of electrolyzer capacity, which will lead, according to plans, to about 1 million tons of green ammonia being produced. There was a project finance deal in 2023, closing about $6 billion of debt capital, and that again included a lot of ECAs. So for example, the electrolyzers for the project came from German ThyssenKrupp, and that then triggered a loan guarantee issued by the German ECA. I could go on with other mega projects, but I think what I'm just trying to convince you here is that if there's any kind of risky, larger energy infrastructure project somewhere, there's a good chance that you'll find an ECA somewhere in these transactions. And that means that they just enable all these pieces of infrastructure on the fossil side, but also on the clean energy side, which shape our energy systems for decades to come. That may be one of the reasons why the Paris alignment of ECA portfolios, so how well what they finance fits the target of keeping global temperatures well below 2 degrees, is quite fiercely debated. So historically, ECAs have been more active in financing and supporting fossil fuel infrastructure, which has been then criticized a lot by civil society groups that have basically called for the ECAs realigning their portfolios with the net zero targets implied by the Paris Agreement. There was a lot of development in this field in the last few years. So at COP26 in Glasgow in 2021, there was quite a big number of countries, actually increased to even more than 30, that pledged to end public finance for fossil fuels abroad. That was then called the Clean Energy Transition Partnership. And then also in 2021, this OECD arrangement, so this kind of rule book that OECD ECAs set themselves, was amended in a way that excludes unabated coal-fired power plants, which was the first prohibition clause ever in the arrangement, as far as I know. And that was followed up also by some European ECAs committing on top to not just end unabated coal-fired power plant support, but also unabated fossil fuel support by end of 2023. But as you all know, things got quite complicated in the energy sector, particularly in Europe with the Russian invasion of Ukraine, which led to some ECAs basically backpedaling on some of their commitments. We've also seen some recent revisions. I'm based in Zurich. We've seen some controversy around the Swiss ECA that changed the policy last year, allowing more support for gas projects, and particularly if they are in the economic or policy interests of Switzerland. We've also seen some criticism of the European ECAs that might not be really on track with some of the phase-out commitments. And against all this background, ECAs being very important in facilitating energy infrastructure and being under a lot of scrutiny and debate in terms of how well the activities line up with the Paris Agreement, we conducted the paper that I'm going to present here, which basically tries to assess how do the energy finance portfolios of ECAs look like, to what extent are they actually becoming greener, and what implications that has. Regarding the data and methodology in our study, first, I'd like to clarify the scope. So we're just looking at the energy sector. Here I'm showing you the activity of OECD ECAs in general. And you can see that the energy generation and supply sector, which is included in our study, only accounts for 50%. So that's just important to keep in mind. While we maybe also might have included some mining if it relates to coal, but there's a lot of other things that ECAs do that we do not look at here. With respect to data sources, we use, at least from an academic side, novel data set provided by TXF Intelligence, which covers ECA involving deals worldwide. The data set is self-reported by marketing players and basically covers a decade of transactions, both with OECD and non-OECD export credit agencies involved. And what we then do is basically we take this data set and classify each deal first into energy sector or not, which leaves us then with roughly 900 transactions that fall into the scope of our analysis. And then we use a classification scheme developed by a coalition of Western European export credit agencies called Export Finance for Future, in short, E3F. which is displayed here on the right, to basically also classify deals based on the exact technology they're using and some aggregates. So for example, we classify into fossil fuels, renewable energy technologies, and other energy-related activities, differentiating between coal, oil, and gas, then also between different segments of the value chain. And we also include, for example, grid and battery storage. And once we've done that, we basically aggregate the numbers up, inflation adjust them, and then assess the overall trends. And I think one thing that I should mention here is that we exclude Canada, which is quite important because it's a very active ECA in the energy sector, simply due to poor data coverage, because the Canadian institutions report far less to the data provider than institutions in other countries, which is unfortunate. Just to clarify our contribution in terms of the data and the analysis we're conducting, we're not the first ones to look at export credit agencies and their role in the energy transition, but we would argue that maybe our assessment is the most comprehensive in terms of what it covers. There's been two strands of previous research on this, one led by non-governmental organizations like Oil Change International, where typically you have a more limited country scope than what we do in our paper, particularly for non-OECD countries. And then, of course, you have the ECAs themselves having the best data and then reporting them to governmental or international organizations, such as the OECD or the Bernie Union, which is the International Association of Export Credit Agencies. They have the best data, of course, but it's not publicly available. We tried getting it. So unfortunately that we could not use. And then they also typically miss the non-OECD ECAs. And then there's also been some nice studies looking into particular aspects, but I think in terms of the countries covered, which we have 31, the different technologies, value chain segments, I think this is really where we can go a bit beyond previous research. And without further ado, coming to the results, this is basically aggregate global ECA guarantees for energy sector deals between 2013 and 2023. So as you can see, volumes are quite substantial, between 20 and 25 billions per year. We split our sample into 4 periods, just for visual conciseness. So we have the pre and post Paris, then we have the COVID pandemic, and then due to a lot of commitments being made at the COP in Glasgow, the post Glasgow period in 2022 and 2023. 2 notable patterns here. I think the first one and the most obvious one is there's a lot of things changing in 2021 onward. So you just see a pretty big collapse in ECA guarantees for fossil fuels and particularly natural gas. And then a bit less pronounced, you just have this very steady increase in support for renewable energy over time, and particularly wind energy. This is just guarantees. If you look at the direct lending, then basically what you see is that the loan portfolio of ECAs overall is much dirtier than the guarantee portfolio. That's somewhat related to who is more active in direct loans and who's more active in guarantees. For example, the European ECAs typically issue more guarantees vis-a-vis direct loans. But also here you can see that there's really a strong reduction for fossil fuel financing in 2021 and onward with this increase in renewable energy. And that means that if we look at just the share of renewables in overall direct lending and guarantees, you have this very strong uptick in recent years, where we're basically reaching levels around 40 to 60% for ECAs overall. So that then prompts the question, okay, is this a trend in just one part of the value chain? Is this just because people phased out coal-fired power generation, for example? So we broke it down by technology and value chain. Basically, I think the main aspect for me from this chart is that you really shouldn't just focus on power generation if you look at ECA portfolios, because you will paint a very nice picture in terms of how green portfolios are, because there's just so much up, mid, and downstream ECA support in oil and gas in particularly. So ideally, analysis should always cover the entire value chain. It works more or less for coal, where most of the ECA support we see is indeed in power generation, and that has decreased strongly in the last few years. So P4 here corresponds to 2022, 23, and it's basically just one Chinese-backed coal plant in Pakistan, which we still have in our sample. Then for oil and gas, basically, there's not so much change in support for oil upstream, but then in the other sectors, we also see this decrease. And in gas, basically, in the last 2 years, this has decreased across the board. And it's quite interesting also to us to see if this trend continues or we see some kind of a rebound in the future. If you look at renewables, then what you can see is that basically there is an increase all across the board, but the primary driver here is really offshore wind. And that ties back to these projects being very large, having a lot of construction risk. So you just have a bit more need for ECA support compared to, for example, solar PV. Next question then that we had is, okay, is this screening trend evenly distributed across countries? Does it somehow relate to ECAs phasing out or not phasing out fossil fuels? So what we did is we aggregated first our results for loans and guarantees, which we call commitments on this chart here, into 2 groups, the E3F coalition, so these Western European ECAs that are more committed to phasing out fossil fuels, and then basically the rest of world non-E3F group. And what you can see here is that basically pre-Paris, the E3F coalition had a smaller market share, but already started with a much higher share of clean energy technologies in their portfolios. But then they greened their portfolio quite a lot also over time and just gained in market share because their annualized commitments just went up. Whereas for the non-E3F countries, you also have an increasing share of clean energy technologies, but at the same time, you have a pretty strong reduction in what they provide in loans and guarantees to fossil fuel projects. If we break this down a bit further by individual countries, on the non-E3F side, the main players in our data and overall among ECAs are Japan, Korea, and China. So you see some greening going on for each of them, but starting from a low level. For Korea, this is strongly driven by ECA support for LNG tankers in particular from Korean shipyards. Also important to mention here for the non-OECD countries overall is that a lot of these countries like Indonesia, Russia, Saudi Arabia founded the ECAs only in the 90s, so or even 2000s. So these are relatively new institutions, and hence we see a bit less overall financing volumes, but typically this is relatively dirty. Of course, that reflects energy systems and also domestic export industries to some extent. But interestingly, for example, for China, the ECA portfolio actually looks worse than the energy technology exports if you try to break them up into clean and fossil fuel technologies, which is interesting and also connects a lot to what we've been hearing from some Western export credit agencies that are concerned about phasing out some support for some oil and gas technologies because they're worried that they will lose market shares to China and also other potential competitors. Speaking of these Western European ECAs, you can basically see that greening trends here are much more pronounced compared to the previous slide. Denmark is leading the way here, which maybe is not that surprising when you think about the very prominent role of the Danish wind turbine manufacturer Vestas in the global market. But again, the Danish ECA portfolio actually looks better than what we see in their trade data. So it's not just this very simple relationship between the two. What we also see is that Italy lags behind to some extent. That tracks with their export industry, which is very fossil fuel oriented. But overall, if you think about E3F, but also non-E3F country, every ECA's portfolio is becoming greener. That just reflects some ongoing shifts in the energy sector, and particularly the power sector. And that then basically prompted us to ask the question, okay, if everyone is seeing this greening shift to some extent at least, what does this entail for the ECAs? How does this change the transactions that they're involved with on a daily basis? And to look at that, basically first we looked at the deal size of the transaction just based on the overall financing volume provided. And as you can see here on the left, the biggest difference is that deals get smaller. And that holds true for the mega projects. So the outlier dots in the chart, which for fossil fuels can reach several billions. And in the clean energy space, we basically only see this kind of transaction size for very large offshore wind projects. Maybe the NEOM green hydrogen project that I already mentioned. But overall, we see that deals get 2 to 3 times smaller when we look at the clean energy transactions compared to the fossil ones. Then we also wanted to look at how long the loans run, so so-called tenors. Not really a clear technology difference here. We were interested in this because there was a big discussion about reforming the OECD arrangement and increasing the maximum amount of loan tenors that can be offered for renewable energy technologies, because countries were worried about being outcompeted by non-OECD ECAs on that front. Actually, we didn't find any evidence that the non-OECD ECAs give longer terms. Actually, a bit more the opposite. Interested to, if someone here in the audience has thoughts on that. I'm particularly interested in that. But again, we didn't see that much changing in the loan tenors if you just think about this general fossil to renewables shift. What does change quite a lot is the nature of the borrower, shown here on the left, which is maybe not that surprising if you're familiar with renewable energy finance, because for these technologies, particularly wind and solar, there's much more what we call non-recourse project finance. So basically the project owners create a special purpose vehicle, a separate company, for example, the NEOM Green Hydrogen Company, which takes out the loans. And then if the project goes bankrupt, there's no recourse to the owners of this project companies. So basically the only thing that the banks can get is the assets of the project company in case of default. And since this is much more prominently used in RE, accordingly, we also see a much higher share of borrowers being these so-called special purpose vehicle project companies in wind energy and solar deals backed by ECAs. But it's actually not that different from, for example, the gas sector transactions, where a lot of particularly LNG deals also use project finance. Same with the financing instruments shown here on the right, where we basically differentiated between ECA-backed loans, other ECA instruments, for example, the direct loans by ECAs, and then also in the same transactions, maybe other tranches provided by public or private lenders. Not too much that I would take away here. I think a much more interesting outcome of the analysis was thinking about recipient countries. So where does the money flow geographically? And basically, to analyze this, first we took the entire sample period that we had, aggregated all the ECA commitments by recipient country, and then displayed it here separately for fossil fuel transactions and for renewables. And as you can see, the fossil fuel country primarily flows where you would expect it, right? It's the big fossil fuel producer countries, the US, Russia, Brazil, Egypt, Saudi Arabia, Indonesia, maybe then also primarily driven by the Mozambique LNG project, Mozambique in Southeast Africa. And if you look at the renewables, then basically most of the money that ECAs provide, or the guarantees that they provide, ends up in Europe. So in the UK, in Germany, in the Benelux countries, and then also some other countries like Angola or Mexico. And that just reflects that IE investments, renewable energy investments during that period were just more likely to take place in high income countries for a lot of reasons. The financing costs being lower, power sectors reform being at a different stage, the grid infrastructure maybe also being better suited to deal with the renewable energy deployment. And that just means that paired with the increasing market share of European ECAs in energy finance overall, we basically in the ECA space for energy finance went from fossil fuel transactions that mostly come from countries where the money comes from, countries like Japan, Korea, and Italy, and flows to completely different regions on the globe, to a renewable centered energy finance space where the dominating ECAs are also countries like Denmark, Germany, and where the money is just much more likely to remain in the same regions. So for example, Europe here, shown in green. And that means that if we aggregate the ECA commitments by recipient countries' income level group, as defined by the World Bank, so low income, lower middle income, upper middle, and high income, you just see this very strong uptick in the share that goes to high income countries over the last 2 years, but which is surely something that we would also see in 2024 the data if we already had it available to us. And what we see is that this mostly comes at the expense of middle-income countries, because what you see as the 22% share for low income in 2022, 2023 is basically just driven by a few mega projects, and it's not really reflective of the overall energy finance landscape. So some policy insights that maybe will also lead to the discussion in Q&A. I think what we first, which is important to state because it's not always appreciated, the ECA commitments for renewable energy technologies and climate change mitigation are quite substantial. So we see like 10 billions annually on average. But at the same time, it's about 5 times lower than what's estimated in the academic literature to provide sufficient climate finance for net zero pathways. So as basically any other source of climate finance, ECA money for climate change mitigation also needs to be scaled up. There is some kind of a rebound in oil and gas guarantees, at least, not so much in direct loans, which might be at odds with some countries' phase-out commitments. That doesn't necessarily mean that these guarantees should be phased out. I think that can be very much debated, also thinking about the fact that a lot of these countries receiving ECA support for fossil fuel projects are highly dependent on them, as classified by UNDP based on share of GDP, share of exports, and share of government budgets. So I think it's very important here to keep in mind in discussion always that the project country context matters a lot. However, what we definitely need more is ECA coordination with non-OECD countries, China primarily, given first that there's very different trends in the ECA portfolios, and then there's all these worries of losing market shares voiced by at least some ECAs that take their phase-out commitments quite seriously. International equity, important to state that, it's not a part of ECA's mandates. So this shift to higher income countries does not directly contrast with their mandate, but of course it's something that governments overall should monitor and then potentially mitigate if this continues in future years. And something that we just realized over the course of this project is the data transparencies for ECAs overall just lags behind other public financial institutions, particularly the multilateral development banks. And I think there's a lot of scope for improvement there just to facilitate more research, which brings me to the limitations of our study. First of all, as already mentioned, we just study the energy sector. So we ignore all kinds of other climate relevant sectors, particularly aviation and shipping, which account jointly for, I think, almost a third of OECD ECA commitments. When we checked our database against other sources, we saw that there's some serious underreporting for some key ECA countries, particularly China and Canada. We did some robustness checks on this, but I think particularly for the Chinese ECAs, it's very hard to get plausible data, but all we know is by talking to different stakeholders and people from the industry is that it's substantially larger than the numbers we have in our paper. Unfortunately, we didn't see a way to get better estimates there. And then I think more on the methodology side and the data side, some limitations are that this is, of course, a merely descriptive analysis. So we can't really distinguish between some time-driven trends and causal effects of specific policies, for example, the OECD ban of coal-fired power generation. We only look at the deals that were backed by an ECA. So we can't really speak to what sense ECAs really cause transactions and projects to happen that wouldn't have happened without their support otherwise, which is usually referred to as additionality. And we also don't carry out an in-depth assessment of what exactly the ECAs do in each transactions and how that lines up with their role for the energy transition. But so I think there's a lot of scope for interesting research here and avenues for future papers. But with that being said, I'd like to thank you all for your attention. The paper has been out in Nature Communications if you want to give it a closer look. And yeah, looking forward to the discussion and the Q&A. Thank you.
Great. Thanks a lot, Paul. Really, I think very, very interesting and very relevant research. Stimulate a lot of questions and curiosity. So let's move over to Samuel. If you, yes.
Yes, thank you. I just speaking like this, I don't have any more slides, but let me start, Paul, by thanking you for the presentation and for a really fascinating study. I would sort of start where you ended off with a commentary on the data quality. I mean, it is astounding just how much expert credit agency and Exim banks have sort of flown under the radar. We have looked at the same data set as you have, the TXF data set as well. And you did a great job, you know, extracting information out of a data set that is actually not quite as perfect as you made it look based on the sort of descriptive statistics that you managed to get out of it, which for me is sort of, you know, already a sort of a big lesson. Here's a big provider of finance in an age where we worry about climate finance and the 6X that we need to achieve, that we completely ignore. And that ignorance goes in two directions, actually, which you both outlined, actually, Paul. One is ECAs are unbelievably dirty in an age of clean energy. They're sort of 2/3 fossil fuel based, or were 2-3 years ago. I think it's now more 50-50. I think that number I have here is roughly similar to the one you had in your chart there. So here's a sector that sort of still, in a sense, caters to the old economy and sort of, if not careful, underwrites stranded assets. So that's one thing that is sort of worth being aware of. And a subset of that, the second thing to be aware of, is that a lot of that fossil fuel underwriting, guaranteeing, is upstream, is sort of in providing new capacity, and of course those assets are a bit harder to switch off than power generation assets, which in a sense are, you know, you can repurpose if you want and retrofit with CCS or something. The upstream stuff that's happening here bakes in quite a lot of fossil fuels. So that for me was interesting. And then the flip side of that, though, the second point is the missed opportunity. I mean, here is a big pool of money that could be redeployed in a much more useful, much more sustainable direction. So those are some of the things that struck me listening to you and reading your paper. Let me maybe say a few words on something we're working on at Oxford together with some colleagues who work with ECAs, actually, and something called the Net Zero Alliance of Export Credit Agencies. And that's sort of a little bit of a think piece that asks, how should ECAs coexist and collaborate with multilateral development banks, of the other big providers of finance, and the ones that sort of the climate finance discussion focuses on, actually, all the debate about meeting the 300 billion and all those good COP29 targets. They're all focusing on MDBs as opposed to ECAs. So the question sort of arises, how do those two players interact? And you went into that right in the beginning of your talk as well, Paul, which was I thought was very insightful. But just to recap some of that, MDBs and ECAs are different beasts in terms of their mandates. The point or the purpose of ECAs is to promote the domestic industry of their home country, so their export promotion agencies, as opposed to MDBs, whose objective is development and poverty alleviation. So fundamentally a very, very different outlook, which probably makes it harder for them to pivot towards green. I don't know, that's sort of a hypothesis that we can put out there. What it does do is, as you've also seen in Paul's charts, as a fair amount of the money actually goes to high-income countries. So even if it was green, it wouldn't count as development finance because it's sort of north-north finance, as it were. So difference in mandate is one big difference between MDBs and ECAs. Another difference that also came out of the presentation is sort of the differences in the tools they deploy. ECAs are sort of 84% guarantees. And if you look at MDBs, it's 1% guarantees. So the role of that risk mitigation, de-risking activity, that's the bread and butter of ECAs. it's not the bread and butter of NDBs. The bread and butter of NDBs is sort of a concessional finance, development finance. So there's a difference there in the instruments that are being deployed. And that has implications. That has implications of the type of deals that MDBs go for and that ECAs go for. MDBs go more for the sort of the early deals, the high-risk deals, the first-of-a-kind deals, which sort of have a development impact that compensates for the financial risks that the financiers might take. ECAs don't do that very much. I wonder whether you agree with that, Paul, but for me, they don't do that. They come in when a deal is commercially viable, subject to some country risks, or so they go much more for mature deals, and you know, sort of underwrite deals that are risky because they're big, rather than risky because they deal with a sort of a new untested technology. So those are sort of some of the differences, which then, for me, give rise to a division of labor that I think we should probably explore more and promote more, as it were. I can sort of imagine a world where MDBs do the sort of the risky early stuff, ensure the bankability of a particular technologies, be it wind, be it solar, and they can sort of do the pioneer deals, as it were, and then ECAs come in after that to provide the scale. So we move from bankability MDBs to scale ECAs, who can do the bigger deals. And you were right, of course, in your statistics that the renewable deals are structurally smaller. They're more modular, and in that sense, they're easier to finance actually than the big sort of LNG terminals in Mozambique, which are, you know, you put billions at risk in renewable projects. You can do that in a much more modular way, but still ECAs can come in, they can produce, they can provide the scale that we also need, of course, in climate finance. So that can sort of become a little bit of a division of labor. The question then is, how does one end up there? How does one get ECAs and MDBs to collaborate more with each other? Actually, one thing that's striking in the TXF dataset, I don't know whether you looked at that, is the number of deals, or the small number of deals that have both an MDB and an ECA component. That hardly ever happens. You either have one or you have the other. And typically it tends to be you have the MDBs first, as it were, sequentially in the time series in a country or in a sector, and you have the ECAs afterwards. So that suggests, again, a need for collaboration, for communication between those organizations, which are, after all, have similar or the same shareholders, so it shouldn't be very difficult to achieve. But it's actually striking when we sort of talk to ECAs and we talk to MDBs, we tend to do that separately. We hardly ever have them in the same room. And if we try to invite them, they sort of, that doesn't come natural. It isn't sort of, yes, of course, I know these guys, I talk to them all the time. It's a sort of, yeah, we don't normally do that. I don't wonder whether it's a good idea. So that sort of psychological barrier, in a sense, has to be overcome and maybe made more formal. We talk in that paper that I was mentioning we're working on, we talk about a sort of the development of a protocol or a template of collaboration between ECAs and MDBs. Again, with the view of bringing ECAs into the fold of organizations that provide climate finance, that help contribute to the 1.3 trillion, they probably contribute to the 1.3 trillion, so the overall envelope of the COP29 agreement, as well as to the 300 billion, which is the narrow public sector part. So they probably come in on the bigger envelope. So that's, for me, the sort of key lessons I take out of this really great descriptive study of an ecosystem, a beast, a set of organizations that we really haven't shone light on enough. There's a big opportunity here That's the main thing I take away, for more collaboration, for raising more green finance. And yeah, let me stop here again, just to congratulate you, Paul, for a pioneering study. It's something that nobody's looked at before, and it seems strange. Now that we've seen it, it seems strange that nobody has. So it's glad you did. So let me stop here and see whether we have any questions.
Yeah, great. Thanks a lot, Sam. I don't know, Paul, you want to respond to that, or we can just also open it up?
I mean, I think I will mostly just agree with basically everything that Sam has said, so I think we can move on to the Q&A directly.
Okay. Yeah, great. Thanks a lot. Thanks a lot, both of you. Actually, really fascinating talk on a maybe underlooked topic. I mean, I think a really lot of angles that for which it matters, right? You talked about the scale, how much it matters, then maybe the sequencing of policies and investors, but also the whole geopolitical discussion and also equity related sometimes that you showed a bit in terms of what countries, maybe there the data availability is even a bigger issue if it's on another country that are not in this exact data set. Yeah, very interesting. Absolutely great. So let's move a bit to discussions. I have quite a few of my own, but I mean, I will give priority to the attendees, of course. So we have two for now. Fabrice Lecuyer is asking, you mentioned that the reason for public institutions to de-risk investments is to push national interests. I think the motivation here is also very important. Do you think this is why they keep doing it for fossils, or is this just, let's say, some inertia or habits, or why is that still so much fossil that we see?
So I think it's a bit of both. So work that we are currently doing right now is to be assessing clean energy technology exports by countries, and then we basically put all this next to the data that I presented. To really investigate which ECA is going beyond kind of like what the export industry demands. If you just look at how much a country exports, for example, PV technology components, or for example, parts that in the end will end up in a fossil-fired power plant. And you definitely see a very strong correlation. I think that's probably just, if you did some kind of predictive analysis, that's for sure the strongest predictor. So the national interest, the composition of the export industry, basically sets the framework for ECA activities, and you cannot change that overnight, not as policymaker, and much less if you're working in an ECA, but you have some kind of phase-out commitments. So I think that is a big driver, but I think, and it maybe also ties back to some things Sam mentioned, I think a habit is definitely also always somewhere a question whether that's, if you speak to other institutions like the MDBs, or what kind of deal structures you're used to, and who you know in the export industry, and how well these exporters know you, and how easily they can access you. So I would definitely think that national interest and export industry composition is the main driver here. But I wouldn't underestimate this kind of habit stickiness on different levels. So I think, yeah, a bit of both, but probably much more the export side.
Yeah, I would agree with that. It's, I mean, the stickiness and the habit and the inertia is definitely a big part, which we also observe in MDBs. So in a sense, the MDBs is the control group, and they, you know, they have the same behavior. So we can see that this matters. But then sort of on the self-interest, just to add one sort of nuance to why this actually matters, is there is no carbon penalty from doing that. You know, if you're a country with a net zero target and a high carbon export industry, you can keep that industry alive without jeopardizing your net zero target, because those emissions will be somewhere else. So the targets that the countries might have don't bite when it comes to the activities of ECAs.
I mean, the inertia is, of course, maybe that would be the easiest part to address on the policy side, right? I mean, because I mean, national interest is always is a very important driver. But let's say if it is really such as some inertia, maybe a bit overlooked part, I mean, it would be really, I think, a first thing could be just to bring much more awareness and communication on the relevance of these ECAs for the finance transition and channeling funds towards carbon-free alternatives. which is would be a low-hanging fruit then, even if it's just, let's say, some kind of habit, which is also could be good news at least. Another question on how are ECAs to fossil and renewable energy fuels affected by subsidies to de-risk nuclear weaponry manufacture when byproduct energy is captured? Are they decreasing proportionally? So the link to nuclear also, and maybe the link to, of course, byproduct from nuclear weaponry. I don't know, did nuclear did that play a role, or is that anyhow?
Yeah, so I can speak to nuclear energy. Nuclear weaponry, I think, falls completely outside of any expertise I can claim. So that part of the question, sorry, I have to dodge. We had some discussions about how to classify nuclear, which kind of echoed also the discussions that we had with the EU taxonomy. Different countries have different positions, different individuals have different positions. There, in the end, what we did is we classified it separately as a other energy together. If we calculate overall renewable energy versus fossil versus other splits, for example, together with grids, together with battery storage. And so basically, if you think about the charts that I presented, nuclear energy won't be in the green side, it will be in the yellow side. In practice, the amounts are very small. I think there's one year, 2016 or so, where there was a big transaction that kind of leads to a little spike. But other than that, it really doesn't matter that much for the results in our case.
Okay, there's a version of the question: do nuclear subsidies affect fossil or renewable energy more? I'm not sure they sort of probably affect them in the same way. I mean, I haven't looked at the data, but arms exports subject to the ethical rules that countries might have of not wanting to export arms to certain countries or for certain purposes. They can be supported through ECA underwriting. So I'm sure under the 85% pie chart that wasn't energy, there probably is some arms underwriting there. I don't think there's sort of a zero-sum game or a budget constraint in ECAs, but I might be wrong in that. So it isn't the case that if we do the nuclear deal, we can't do the renewable deal. I don't think ECAs are constrained, financially constrained to that extent that they have to sort of choose, I can do that and then I don't do the other. If a deal comes around that meets their criteria, including their ethical criteria and their financial risk criteria, they can do it.
Yeah, no, I think the role of subsidies in general I don't know how, there's a big discussion on fossil fuel subsidies, right? And also the inertia in this. I don't know how much it is linked, or like that, of course, keeps up demands also in some countries. I'm not sure how that's linked to these projects, but could be. I have maybe two a bit simpler questions, being also not an expert on the topic, maybe for people that are a bit less aware. So for at least MBBs, I know they do often this kind of also kind of a social welfare analysis or cost benefit analysis. For instance, you could include things like the social cost of carbon on projects, right? Which I think some MDBs have been doing. I don't know if that's something that's sometimes done in let's say project appraisal, or also on the financing side in ECAs, or similar. What about the, for instance, assumption on fossil fuel prices, right? I mean, I've seen several studies on, let's say, on Middle East, where it's always, of course, a key driver is fossil fuel price assumptions, right? And this depends now more and more on policies, for instance, on outcomes of the COP and others, right? So there's a kind of this a feedback loop from policy towards kind of the viability of these projects, which also then affects financing, etc. So I wonder, yeah, if these kind of things are considered by I guess at the project level for sure, but is it not discussed the social cost benefit analysis and also like price, let's say, implications of global climate policies, which could reduce prices and therefore kind of the demand, right, and the kind of the the cash flows of all these projects. So I don't know if that's kind of being discussed or you consider, or that doesn't play a big role at this level. Out of a curiosity more,
Yeah,
if you have any insights.
I've never sort of carefully looked at the project appraisal habits of ECAs, but to the extent that I understand it, it's purely a financial analysis in project appraisal. So it's not an economic analysis. So you don't price externalities and worry about social outcomes or anything like that. It's a purely sort of does it make commercial sense, and do I get my money back, or do my exporters get their money back? So that's what it is. But there's one thing we sort of talk about in our forthcoming policy brief, which is sort of the question whether ECAs have to become a little bit more like MDBs, both in terms of their objectives, so have a little bit more of a sort of a social objective rather than a sort of a purely domestic objective. And hand in hand with that would be a sort of a broader aspect of project appraisal. I mean, there is a subset of ECAs that are now committed to have a net zero target, and they're starting to wonder what it means operationally to have that target, and how one operationally decides which deals are consistent with it. And that moves ECAs gently in the same direction in terms of project appraisal as MDBs are.
Okay, great, interesting. Maybe you could share the link of the policy brief. It sounds very relevant and interesting.
As and when we have it, we'll be happy to.
Okay, perfect. Great, thanks a lot. We are at the hour. I ran even 2 minutes over. Sorry for that, but I think a really interesting topic, and you can see the full recording on YouTube. Thanks a lot for joining us today, and a special thanks to Paul and Samuel for having the time and sharing this really I think fascinating topic with us. And look forward also to a policy brief and further works as we go towards the next COP in Belém. Thanks all. Have a nice afternoon, and see you at the next webinar in December. Thanks again, and have a good rest of the day.
Thanks, everybody. It was a great discussion.